just look the last 3 years. In 2022, it made sense to add to holdings and add risk back into your portfolio, which is what we were doing. 2023, we got another summer swoon in technology and growth stocks in general. And now we're seeing it again. I think, you can't underestimate the power of the hedge funds and the hedgies going to the Hamptons and pulling some of the volume out of the markets and increasing volatility. Then you've got this, the carry trade issue. But at the end of the day, it made sense. I mean, we had some real big pullbacks in the 1990s, but the NASDAQ was up 820-something%, and the Dow and S&P were up about 450% with higher interest rates. So 10-year between 5 and 8%, with higher inflation averaging around 3%, a labor shortage. What we haven't talked about, and what I thought was the bright spot from last week, is productivity. It came in well ahead of expectations at 2.3%. It was revised up, and that put pressure downward on unit labor costs, which will put downward pressure on inflation. Chairman Greenspan understood that. And so let's hope that this Fed does, because you can have, a GDP now of 2.9%, as it was recently revised up to, and you can have growth that is less inflationary than most people would expect.
Nancy, it's worth talking more about the macro. We're talking more about positioning. But another example here that I think is pretty fascinating is you look at a market in search for options. And on the flip side, you see some major pain in some of those consumer-focused stocks. You see Lumen Technologies, after a 90% surge yesterday, another 40% this morning. And I wonder how much money is just flocking to the AI names that work and bursting valuations to a place that maybe are unsustainable.
Yeah, see, I think that's the point, Chanel. I mean, that's what always happens when you have emerging technologies. And we learned that painfully at the end of the 90s when you had, analysts measuring eyeballs instead of earnings. And I think at the end of the day, stocks trade off of earnings. So in the near term, we have all these other, sort of shocks that drive the short-term returns. But long-term, companies trade off of earnings, and you need to own the companies that are going to survive this. And so as obvious as it sounds, you want to own Microsoft because they'll buy the competitor that's leading edge. And they have leading edge technology themselves. But those are the kind of places where I want to hide. If you think the economy is slowing, and the GDP now number will go up and go down between now and the end of the quarter, but it is slowing. The labor market is softening. You want to own the reliable earners. And if you look at, consumer stocks, as you pointed out early, Pepsi, and Procter & Gamble, they have no more pricing power. And their earnings growth is going to be mid-single digits, and they're trading at 21, 24 times next year's earnings. I'd rather own Microsoft that's growing 15, 16% at 31 times earnings, just as an example. So it matters. You want to stay away from the new fractional companies.
Nancy, we thank you so very much for your time. That is Nancy Tengler, CEO and CIO at Laffer Tengler Investments. And it's interesting, Matt, it's not just Lumen that is rising today. You actually have every company in the Philadelphia Semiconductor Index rising this morning. The SOX is up more than the rest of the market, up more than 3%.
Yeah, good breadth today. I noticed 434 stocks are up right now in the S&P 500. So really ripping. This is Bloomberg.
This is Open Interest, and a quick check on stocks this morning, ripping as we've been talking about here. S&P 500 up more than 1.4% with a broad-based jump in most of the stocks in the index. NASDAQ 100 jumping even more, 1.8% higher. Those small and mid caps also seeing some love, Matt, 1.4% higher.
All right, let's get your top calls for you. Some of the analysts' action in focus this morning. First up is Loop Capital Markets cutting Trex to a hold. The outdoor decking company lowering its sales outlook for the full year. The Loop analyst says headwinds are more significant than had been anticipated. Next up is TD Cowen cutting its recommendation on Molson Coors to a hold. The analyst says the beer giant didn't hold on to share gains from last year's Bud boycott, especially considering that shelf space for Molson Coors beverages increased by 13%. They should have taken advantage of that and failed to. Finally, B. Riley is downgrading TripAdvisor to a neutral. The online travel site missing second quarter revenue estimates. The analyst says the disappointing report reflects deterioration in the company's core business. Shanali?
One stock to watch at the open is Disney. The company posted its first ever profit in the streaming department, but it's offsetting sluggish performance at its theme parks, which are seeing moderation in demand. You're seeing Disney shares down almost 3%, and CFO Hugh Johnson spoke earlier on Bloomberg Surveillance.
The lower income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher income consumers are tending to travel overseas a little bit more right now. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
Madison and Wall principal Brian Weiser joins us. You see the entertainment numbers out there. That's really what's spooking the market a little bit this morning. When it comes to Disney, you have the CFO saying that it's, let's say, somewhat of an aberration, not something more consistent. Bloomberg Intelligence, though, disagrees. Brian, how do you see these numbers playing out?
Yeah. Well, I thought the advertising numbers were certainly very strong, although they had also very, very easy comparables from the year ago period. So it's kind of hard to read that. You may have seen Tegna also just came out with numbers which were probably closer to where the underlying TV business is at -5. And if you think about that, Disney did quite well, all things considered. When we look at the streaming business, they're continuing to grow and make good progress there. I think that the shift to including ad-supported offerings for Disney Plus, obviously really positive. Hulu's doing well. Consumers are willing to spend money on these services. And so I think that's probably, that's the stuff that I'm focusing on. It's a strong business in the long term because they are investing in content. They could be investing more. I think Disney Plus would probably benefit from more of that. But ESPN also is doing quite well, remarkable numbers from the quarter.
I wonder about the parks business just because we've seen some eye-popping numbers recently, Brian, in terms of costs. I think I saw a report that a high-end trip with a family of 4 costs $40,000 to Disney World. Are they regretting their price increases, or are they going to hold tight, since at least they're not seeing a decline, right? They're still seeing 2% gains year over year.
Yeah, well, I mean, I don't spend too much time thinking about the travel business, but I think that maybe I could point this out, that consumers are still spending an awful lot of money on services broadly. When I looked at the latest services quarterly survey from the Census Bureau, I mean, it looks like we're going to still see mid to high single-digit growth rates of spending on services. And exactly as Hugh Johnson pointed out, the higher-end consumer is probably driving that. The lower-end consumer is probably not. Now, can Disney parks, see some short-term challenges because there's going to be more spending on travel abroad? It makes sense to me. But the underlying spending patterns in terms of higher spending growth skewed towards higher income consumers, I think is probably going to help them in the long run.
You think about Disney and the position it's been in the last couple of years, and in this earnings report, they really do tout pretty high up what they're seeing out of ESPN, ESPN Plus, and of course, there are some interesting deals happening in that industry ahead. Do you think that there's still a rationale, Brian, to bring up that conversation about what it would look like if ESPN was spun out of Disney?
And Brian, by the way, is a former investment banker, so you're pitching these kind of deals, right, Brian?
Well, once upon a time, it does make a ton of sense because the dynamics of sports and sports-related video programming are so different than the rest of the industry. It made a lot of sense in a world where you could tie together access to the distributor to the sports-related product if you wanted the other product. Rather, you want sports, you're going to get all this other stuff you don't want. In this world that's more a la carte, it's a lot harder to tie those things together because the cost profile of sports-related program is just so significant that you will not be able to avoid spending 8% more per year on the underlying sports rights. Whereas with the rest of the content business, those costs can probably go down. I mean, we talk about what an AI-driven content world starts to look like, especially when you look at reality TV and a lot of other programming, not news, not business news, certainly. The profiles of these businesses will look very, very different. So I do think that there is still a significant rationale for ESPN to eventually be spun out.
All right, Brian, great to get your take. Brian Wieser, not only famous for the analysis that he's done in media, but also for his investment banking experience. Great to get some experience, some wisdom from you on this earnings report. Coming up, we're going to talk more tech, but less media. Tech-heavy hedge funds lost hundreds of millions of dollars in the recent sell-off. We'll discuss the ones that were hit the hardest next in our Wall Street Beat with Hema Parmar. This is Bloomberg.
Time now for the Wall Street Beat. After the global sell-off took place earlier this week, some of the world's biggest hedge funds lost hundreds of millions of dollars as a result of being in the most popular of tech stocks. But the market turmoil helped Brevan Howard's flagship hedge fund swing to a profit for the first part of the year here. Joining us now is Bloomberg hedge fund reporter Hema Parmar, who's had her eyes all over the industry, and it's been a very volatile year. When you look at Brevan in particular, I think it's an interesting moment for macro funds to be capitalizing on things. They had lost some money earlier this year due to wrong way bets on Fed cuts. How did the turmoil help?
Yeah, so you're actually seeing an example of a fund doing well in this market. They were down before July. Now they're up about 1%. They made about a 2% gain in the past couple days, which is, really good for them. They have been saying since January that the market isn't pricing in enough rate cuts to come. And so so they are expecting more to come, and it looks like their bets have helped them.
What's going on at Light Street?
Yeah, so this is a fund that is not winning, down 9% in 1 month of July alone. They may be down more when you look at the turmoil in August. Up 40% for the year, but keep in mind this is a fund that has big bets
40% for the year, including the bad month.
Including the bad month.
Yeah.
That's what I was going to say. They did really well before this.
They did, but they're still digging themselves out of 2 years of losses. In 21 and 22, they were down a collective 40%. So, they're trying to dig themselves out of this high watermark. Their biggest position, NVIDIA, about 17% of their portfolio as of March. Sizable chunks in these tech stocks, and that can work for you and the market's great, but when you see a really difficult month, it can really backfire.
How about some of these Tiger Cubs? It's interesting to see what's happening at Tiger Co. 2. They had similar problems, to my understanding, as Light Street. Mm-hmm. How does this year complicate getting out of that kind of high watermark moment that they're grappling with?
Yes, a lot of funds had a very difficult couple years and need to try to get out of that hole. And so, every month matters. Every month that you're not making money impacts the year-to-date return, impacts what investors expect, and will impact whether or not they continue to stay in the fund or they give it more time. So, until investors are made whole, the firm is also not charging fees to the full extent. And so that impacts how much they're bringing in terms of expenses and revenue.
Joe, pull up that full screen again of their holdings, because I think it's interesting to look at the fact that they're green check marks on almost every single one of these stocks for almost every single one of these hedge funds.
Yes.
I mean, it's a herd.
Concentration risk you're worried about too.
Exactly.
Precisely. So, these funds, generally Tiger Cubs, even some that are not, these are their top 10 positions. Their biggest stakes are in these companies: Meta, Amazon, Microsoft, NVIDIA. So it's unsurprising that when you see a very difficult month in tech, that you see this pain kind of across the board to different
extents. But why pay 2 and 20 for that? Why don't you just buy the cues?
There were some funds up. David Einhorn was up. Rentec was up. So let's not throw all the babies out with the bathwater, Matt.
And they're less tech focused too. So they're more healthcare and other things too.
All right, it's interesting because, if you just own the S&P or the Qs over the past 10 or 15 years, you're outperforming any of those hedge funds. So, Hema, great to have you on to talk about the horse race. We've got to do this more often because I think it's pretty fascinating stuff. Hema Parmar covers hedge funds for us on the print side. In terms of what we're seeing in the markets, still green arrows across the board and getting better here. The S&P 500 up 1.4%, the NASDAQ up 1 2/3% almost. We've seen the Russell sort of hovering around that 1 1/3% gain. Coming up in the next hour, MicroStrategy Executive Chairman and Co-founder Michael Saylor is going to join us. I will tell you, he likes Bitcoin.
Yeah, he
does.
I'm
going to say he's going to go long Bitcoin. 10:30 a.m. Join us for that interview. This is Bloomberg.
First jobs day like Bloomberg.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Bassett. Katie Greifeld is off today. And coming up, dovish signals from the Bank of Japan give fresh legs to the recovery in global stocks. But worries remain. Disappointing earnings reports continue to pile up, with Disney and Airbnb showing real weaknesses in the consumer. And we'll get the view from the C-suite this hour from Resi CEO Pablo Rivero and MicroStrategy's Michael Saylor.
Let's get a check on where the markets are right now. Seeing some decent gains here, 1 2/3% on the S&P 500, and some really good breadth as well. If you take a look at the S&P right now, the move function on your Bloomberg will show you that we have 458 stocks gaining. So almost all of them are up. The NASDAQ gaining 1.9%, almost 2% there. We know that the Russell's up as well. The 10-year yield at 393.73, and Sonali, as you point out, we're looking at 399 right now on the 2-year. No, just over 4% now.
Woo, we broke
on the 2-year yield. So investors selling off those treasuries that they were clamoring for on Monday.
But if you're buying that 10-year auction today, you're looking at 393. It might be below 4% for the first time in a while. Now, we're also watching Europe's most valuable company, Novo Nordisk. The stock needs a checkup after reporting disappointing sales of its blockbuster weight loss treatment, Wegovy. The company's CEO spoke with Bloomberg's Francine Lacroix earlier this morning.
The second quarter is a quarter where Wegovy came in a bit short of consensus, and that's linked partly to some adjustments in how we accrue for rebates. So I would really urge investors to not just look at the quarter in isolation, but look at our confidence in the rest of the year and the upgrade we are bringing.
And for more on Novo's quarter, we are joined by Bloomberg Health reporter Madison Muller. We're also going to talk about the competitors here. When you look at the numbers themselves, you look at the competitive pressure, you look at also the relationship to insurance companies and pharmacies here. Does this sell-off seem warranted given those concerns?
Right. The thing is, I mean, the expectations for Novo Nordisk and Eli Lilly are so high, and that's something that we've talked about before. I mean, the margin for error for them is very small. So anytime there's, a competitive pressure, a supply pressure, or they miss estimates, it just affects them a lot, and that's what we were seeing this morning. It's actually a good thing that there is more uptake and that we're seeing more insurers cover the drug, but that also comes with more pricing pressure because of the discounts that are offered, through the pharmacy benefit managers.
So we're not talking about, they're not selling fewer drugs, it's just that their prices are getting compressed, right?
That's
by
part
the
of
pharmacy
it, yeah.
benefits managers.
I mean, the problem for Novo Nordisk right now is they actually they're struggling with supply. I mean, that has been the problem still struggling with supply. As of today, actually, most of the doses of Wegovy are listed as available in the FDA's shortage database, but Novo is having to continue limiting these lower doses, these starting doses of the drugs, because their supply is still so limited.
Can I ask, you cover the drug maker side, but I wonder about the insurer side. I tried desperately to get a hold of some Wegovy. My doctor said, okay, you're 50.
But did they tell you that 1 pint of ice cream was not enough?
A day. No, the problem also is, I'm 50, I'm a little overweight. I'm worried about my heart. I want to live longer. So I feel like it's preventative in some ways, right?
Yeah.
We've seen studies that show these drugs are good at staving off heart attack risk. Why don't the insurers want to pay for the drug now rather than pay for my hospital stay when I have a massive coronary arrest later?
You are not going to have a coronary arrest.
Thank you.
Well, that's the argument that the drug makers are making, and that's why they're running all of these studies to prove, without a shadow of a doubt, that these drugs do these things and that they're able to ward off these other health conditions. And we are seeing more insurers covering them, but at the same time, because the drugs are so expensive and because so many people can potentially benefit from them, it's really putting a lot of pressure on these insurers. It's becoming really expensive. So at the same time, we actually are seeing a little bit of a pullback from some insurers who are just saying it's not possible to cover all of these.
How does the competitive pressure stack up, knowing that Eli Lilly is reporting after market today, and also given the not only weight loss potential of this drug, but for all of of these firms to really race to figure out what the other treatments are. Novo had announced that they kind of delayed one of their major kind of studies here, didn't they?
Yeah. So Lilly reports tomorrow morning pre-market, and Lilly has actually been, their supply situation has been getting better. So it's this interesting dynamic right now of Novo is still struggling with supply, Lilly's is getting better. So I saw some analyst notes this morning wondering whether, that's affecting decisions in the clinic of are people choosing Zepbound because it's just available, and that's a potential benefit for Lilly. When it comes to other drug makers and competition, we do have so many others that are now trying to get into this market. But, Lilly's CEO has said it'll be a few years still because they have to do these late stage studies to get approval. And so Novo and Lilly still have a huge advantage potentially for years to come because they're so far ahead of this. And we did see Novo delay one of their major studies in heart failure, and they are going to refile for approval next year. Lilly recently had a study in heart failure as well. So it's just, they're neck and neck in terms of studying these drugs and different diseases.
Although Lilly's an outperformer over the longer term, I always pull up the comp screen on the Bloomberg, and it defaults to 5 years, which I think is a nice time period to look at. Novo Nordisk total return 462%, which is not bad, right? But Eli Lilly total return 659%. Yeah. Unbelievable returns there. Madison, thanks so much for joining us. Madison Muller there talking to us about the GLP-1 makers. We're joined now by Ellen Lee. She's a fundamental portfolio manager at Causeway Capital. And Ellen, I want to get your take on, the effects of these drugs, not only on the makers, but also on, if I look at Pepsi, I'm worried that people are going to buy fewer Fritos here. Do you think about GLP-1s in terms of real market-moving effects?
As of now, as the analysts talked about earlier, I think there are definitely supply chain issues at this point. So I think really determining when wide adoption will happen is the key barometer in which how fast these drugs can hit the demand of the snacking companies and, restaurant companies, as well as even, beverage companies. So yes, I do think about this risk longer term, but I'm also, hearing what Novo or Eli Lilly are doing and also Roche are doing in terms of advancement. But yes, it is a lingering fear, yet as of right now, the adoption is slow. So we'll have to see. It's still early days to make an assessment of when it will start to significantly impact, if ever, these snacking companies.
One question I have about the pharma industry is it's really easy to latch on to the allure of these weight loss treatments. But at the end of the day, it's such a specific and small part of the overall healthcare story, a sector that a lot of investors are gaining increasing interest in this particular environment. How do you navigate the sector?
I think, for us at Causeway, when we do bottom-up research, we're not just looking at the phenomenon of, meeting your, colleague or your friend who's just taken Wegovy and lost 50 pounds. We are actually looking at the supply chain, meaning, okay, is there a supply capacity there? And then we're also looking at the insurance companies to see, what the affordability will be like. So you have to look at it from the manufacturer all the way to the consumer and not ignore the supply chain issues that gets in the middle in terms of accessibility. And that's sort of key to understand, the adoption rate in the long term.
These stocks are still big high flyers, and I know that you're looking for more value, right, Ellen? At least if I look at the stocks that you're interested in, Kering, for example, it's a luxury goods maker, but it's been discounted by the market on concerns about a recession. What do you think about the luxury goods market right now?
You're absolutely right. Luxury goods market is tough. Obviously, they had their day in the sun a few years ago with COVID and so much discretionary income. I think in the current market, as you mentioned earlier, markets have been very strong. And there are reasons to be optimistic about a soft landing and also on the converse be pessimistic about a hard landing. But we're looking at the company's valuation, and to try to mitigate for what could happen in the macro environment, we're looking for opportunities where the downturn is already priced in. So in such case, we believe stocks like Kering, even though their earnings could fall during a downturn, much of that is already discounted, and therefore that gives us margin of safety in a scenario where there is a downturn. And also, if you look at the valuation gap between companies like Kering versus LVMH, the margin of safety is there for us to believe that, when Gucci, the brand, does recover with its new products that's hitting the stores today, there is plenty of upside.
Ellen, we have to leave it there. That is Ellen Lee of Causeway Capital. We're going to get a look at the stocks moving this hour. Of course, a lot of things under the surface here. Abigail Doolittle is here to join us. Abby?
There certainly are, Shonali. Let's start off with the shares of Fortinet absolutely soaring, up more than 24%, heading to the best day since 2009. This after a massive beat. They put up 57 cents in adjusted earnings. That represents a greater than 40% adjusted earnings beat, 2.2% revenue beat, margins good, billings growth good. Investors really liking this stock. Let's turn to the shares of Dell. Now, this is not an earnings report, but this is interesting because it could give us a sense on the global IT spend. Shares down nearly 4% right now. They're laying off some managers and sales staff to, quote unquote, get leaner amid a modernization. But again, when you see a company like this making these sorts of cost-cutting moves, you have to wonder, does that represent something from their customers? And then finally, let's take a look at some of the other tech names on the day. We have continued rebound. Importantly, Apple's now joining in, up 2.5%. Microsoft, Meta, NVIDIA higher. What's interesting here, Matt, is some of these stocks have what's called a quote-unquote V-bottom, a bottoming process that can take stocks sharply higher. Others don't. What they all share, though, is not so good-looking weekly and monthly charts, suggesting that any sort of rebound that we're seeing right now, it may not last for too long.
All right, always great to get the fundamentals from you, Abby. Thanks so much for doing that. Abigail Doolittle looking at some of the big cap tech stocks there. Coming up, the Harris Waltz campaign says it raised more than $20 million in the past 24 hours as it heads to multiple battleground states today. Details on the campaign trail next and the state of the race. This is Bloomberg. All right, let's get to high interest to look at what's making headlines around the world. Steve Mnuchin says it's time to kill his own creation, the 20-year Treasury bond that's costing taxpayers a lot of money. The Treasury reintroduced the 20-year bond in monthly auctions 4 years ago, but it fell flat with investors. U.S. 30-year mortgage rates plunged last week by the most in 2 years, reaching their lowest level since May of 2023. The drop has sparked a surge in refinancing applications, with one index jumping last week to a 2-year high. And Vice President Kamala Harris is stepping up her efforts to bring rank-and-file union members in swing states back to the Democratic fold. She's being joined by her newly named running mate, Minnesota Governor Tim Walz, at rallies in Michigan, Wisconsin, and with the United Auto Workers President Shawn Fain expected to join them in Detroit. Shonali?
Let's now discuss the state of the race with Bloomberg's Anne-Marie Hordern, of course, the chief political correspondent over here at Bloomberg Television. And you look at her getting on the road here. What do you expect?
So I think what they're going to do is similar to what we heard last night. This is really them going out and getting some excitement. This is a brand new ticket, very different than where we were with Biden at the top of the ticket. It's obviously a much younger ticket. There's an enormous amount of energy, if you watched last night in that room and speaking to some of the reporters who were in that room, about the excitement that this is just new and fresh. So they have to go out and talk about what they care about. They're going to lean heavily on abortion rights, if you heard that from yesterday. And you also see them trying to take this different tone. It's more of a positive tone. They don't want to look back, except to saying that we're not going to go back there. They are trying to take a more upbeat, positive tone, leaning into the fact that they are fresh. What is also very important is when you look at the Marist poll that was done before she selected Tim Walz, the governor of Minnesota, potentially now those numbers will change a little bit, but more than 70% of Americans do not know who this guy is. So he also needs to introduce himself to the American people, and I expect a lot of that is going to be what they use these next few days for.
The Republicans will bring up the protests from the pandemic era, the Black Lives Matters protests. How vulnerable is Walz when it comes to that? And then Israel hawks are unhappy that Shapiro wasn't picked. How hawkish will Shapiro Walz be in the fight against Hamas in Palestine?
So Governor Shapiro came out last night because it was in his backyard. It was in Philadelphia. It came down to him and Walz. The New York Times just ran a story about 40 minutes ago talking about the fact that Governor Shapiro, according to their sources, had called back, asking a little bit more about what his role would be. Some of them actually equate him to maybe a fresh kind of orator, the way Obama was, maybe taking the shine away from Kamala Harris, although there were definitely calls that he was potentially too much of an Israeli hawk for this ticket, which is why the Trump campaign didn't want him for that reason, and also for the fact that he would potentially just shore up Pennsylvania in full. When it comes to Walz and how they're going to try to pigeonhole him, as I said, more than 70% of Americans, according to this recent poll, don't know who he is. So it's a race to try to define him. We know what the Harris campaign is going to say about him. Republicans are going to really want to focus on two things. You mentioned what happened with the Black Lives Matter protest. What we saw in the state when he was governor, there's a lot of criticism that he didn't bring in the National Guard early enough when there was the upheaval following the tragic death of George Floyd in 2020. The other area of concern that Republicans are going to want to talk about is social concerns, things like gender reaffirming and the fact that they are this refuge state. And potentially, if your child goes there, can you get a court injunction to bring your child home? These are going to be areas where they're going to try to say he is too left and he is too progressives. If you look at the Wall Street Journal editorial board today, they struck a similar tone that we discussed yesterday off of Terry Haynes' note, which is the fact that she doubled down on the progressives. You see the Democrats and the Republicans both doubling down on their base.
You know, one thing I think that's kind of interesting, you think about the social implications, but also the business implications. And the idea that you're bringing on another person that leans left, there are interesting dynamics here. Yes, he is kind of pro-union here, has union support. He did also veto a bill that would have set minimum wages for gig economy workers, Uber, Lyft drivers, kind of from a threat from Uber here. But interestingly enough, with Tony West also really working more on the Harris campaign, I'm wondering if there are signs of light here in terms of how they might approach the business community.
Well, I think the big thing what's going to happen next year, and you've even heard senators call it this, it's tax Armageddon. They have to come to a tax deal because the Trump-era tax cuts come to an end. Now, if you look at Governor Walz's policy when he was Congressman Walz, it's very different. He actually voted at one point against Democrats to extend the George W. Bush tax cuts, but at other times he voted with his Democrats. He was way more down the center. One thing for sure, though, when it comes to tax policy, potentially do we see the lowering of the corporate tax rate? Well, the White House is only one part of this. We really need to see the composition of Congress, and that we're not going to know till November 6th.
Absolutely fascinating.
Yeah, thanks so much for joining us. Anne-Marie Horton and I are talking politics.
Want to quickly actually
Did
check
you want to
on
look at the
something?
2-year?
I sure did,
Yeah.
because I am just absolutely stunned today by the movements in the bond market here. If you take a look, we are flirting with 4% now, firmly at 4%. The 2-year was as low as 364 earlier in the week in the midst of the panic. That big rush into the bond market actually now pretty much entirely reversed, though still about 100 basis points of cuts priced into the markets, Matt. Stick with us. This is Bloomberg. And it's time now for Social Climbers, the companies making waves this morning. And first up, Shopify riding highs after beating second quarter earnings expectations. The Canadian company's AI-powered tools are pulling in more merchants to its platform. And then up, Lumen Technologies extending gains after raising its forecast for free cash flow. The telecom company said AI demand is driving billions of dollars in new business. You have Lumen now up more than 26% after a rally yesterday as well. Finally, Intel reportedly passing up a $1 billion investment in OpenAI in 2018 that would have yielded the chip giant a 15% stake in the company. At the time, Intel decided against the deal because then CEO Bob Swan didn't think generative AI models would make it into market in the near future. Intel is not commenting on the report. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal.
All right, Rivian sees flat production this year, but its CEO, RJ Scaringe, expects output to grow in 2025. Ed Ludlow and I spoke with Scaringe in the last hour on his deal with Volkswagen.
The Volkswagen partnership is something we're really excited about, but the focus of this is around leveraging our network architecture, our topology of computers, the topology of electronic control units, the ECUs in the vehicle, and then, of course, our software stack. It does open the door to other types of partnership and activities we could be doing with Volkswagen Group, but to date, the core focus, the singular focus is around our software and electronics technology.
All right, so he has been using that software technology and those ECUs to update their core product. That is the R1S, their core SUV product, I should say, at Rivian. We're joined now by Bloomberg's Hannah Elliott. She is also my co-host on the Hot Pursuit podcast, which, if you like cars, you should listen to. And she just recently got out of one of the updated R1S trucks. Hannah, you got a story out on the new, I guess, improved Rivian. What do you think?
Good morning, and I will say you are right. It is improved. I drove the R1T truck in 2021, and at the time I thought it was pretty cool. I had some things to work out. This second generation R1 platform, I drove the R1S, the SUV, really does have some notable improvements. I think the biggest thing is the software, the infotainment, all of the electronic systems inside are really, in my experience, were flawless, and that was not the case before. We have just so much more capability inside with connectivity, with entertainment, navigation, that sort of thing. So that's a really big improvement. And then also we have a nice extras. We've got the panoramic sunroof that now goes to dark if you want. We've got heated and ventilated seats. We've got a lot more trappings of luxury. So yeah, I would say it's improved for sure.
How does this compare to the other big luxury family vehicles you could get? I want a truck where I can put my kids in the back seat. You've got, to deal with your dogs and Magnus's beard. Is it a great, big, expensive family truckster?
Yes, it is a great, big, expensive family truck. The one that I drove was the Performance Dual Max, which starts at about $95,000, and with the options that were included in the one that I drove, it was over $100,000. So yeah, it fits 7 people. It has a lot of capability. I love that the seats lay completely flat all across the back. So there's a lot of practicality, but it's expensive. It's more expensive than like Kia's EV9, which I know you and I both love. It's actually more expensive than the Cybertruck, which slightly different vehicle because it's a truck versus an SUV, but very similar too in size. So yeah, it's expensive, it's practical, it's expensive.
All right, Hannah, thanks very much. We'll check out the story on Bloomberg.com. Hannah Elliott is the co-host of Hot Pursuit, Bloomberg's weekly podcast for car lovers. You can check it out on the Bloomberg Terminal or wherever you get your podcasts.
This is Bloomberg Open Interest. You gotta love a day with divergence. We're gonna get a check on these markets with Bloomberg's Abigail Doolittle as stocks are climbing around the world.
Stocks are climbing around the world, but we still have that Monday to think about, and actually the days leading into Monday. But on the week right now, we do have the S&P 500 down about 0.8%, not showing the big drop. But again, on Monday, down more than 3%. Some stocks trying to counteract this, though, and maybe bring the S&P 500 and other indexes higher. Take a look at Lumen Technologies, up 25%, massive free cash flow forecast. The communication companies does have a 13% short interest. That could help to explain it. In addition, this stock, not for the faint of heart, up 246% this year. Yesterday alone, up 93% in anticipation of that strong quarter. Instacart up just 0.8% earlier, higher. They did put up a earnings beat and also a sales beat. Investors mainly liking that, plus a good earnings outlook. TripAdvisor, though, not so much. Take a look at this. Shares down 13%, revenue miss, and in particular, Experience and Dining Week. Reddit down 5.5%, strong results, but a mixed guide. So some winners, some laggards in terms of earnings. Let's take a look at two big movers to the downside, however. Airbnb down 15.2%, the worst day ever since IPOing just a few years ago. There was a weak outlook, a guide. This is, again, the worst day ever. And then Disney down 1.8%. Overall, the quarter was fine, but Parks Week really highlighting, Matt, these signs that we're receiving from multiple companies that consumers are starting to get a little bit price fatigue, spending fatigue, and are tightening down the wallets a little bit.
Yeah, absolutely. The consumers, the visitors to the parks are up, but only 2%. That's weak growth. Instead, they're staying home and ordering, Disney Plus or watching stuff on Hulu and ESPN. Abigail, thanks very much for that. Abigail Doolittle talking to us about the difficulty that the consumer's in, as evidenced through earnings. We see that in TripAdvisor with bookings weaker than expected. Same is true with Airbnb and Disney Parks. Let's talk about that right now with Resy. It's a restaurant platform that you probably use as well. Shonali and I both do, logging its 600 millionth reservation just last month. Joining us now is the CEO, Pablo Rivero. Pablo, it's great to have you on at this time when we see it looks like the consumer isn't going out as much, not booking an Airbnb, not going to Disney World, and staying home instead. Do you see that mirrored in your platform?
Oh, well, first of all, thank you for having me. I'm very excited to be here. What we're seeing is consistent demand for dining. People are still going out, right, trying to find that human connection with people, right, and dining table is a perfect space for that. Our results show that dining demand has been consistent quarter over quarter.
But is it divergent? Are you seeing people start to trade down on restaurants? Are you seeing the kind of luxury end hold up and kind of the bottom range hold up?
Well, it's a neighborhood by neighborhood story, right? Restaurants are the heart of that community, of that neighborhood. So you do see that some restaurants, right, can be hurting by higher prices, inflation, then rent, and so on. But at the same time, you see new demand, new concept, right, going into the high end of the restaurants as well as casual restaurants.
But if you look at the graph of, reservations over time, is the slope still, up and to the right? Is it convex?
It is city by city story, right? So we do have stable across the macro environment, across the United States, but every city has a different story. Any neighborhood has a different story. But demand and spend is still there. Just last year, American Express reported $100 billion of spend on dining, right? Which is one of the highest categories for card members. It is a passion area. We do see diners still going out and finding that opportunity for that human connection on the table.
One thing I'm wondering about, that strategy-wise for you, you have this app where you touch millions of consumers. You have this kind of relationship with Amex. They acquired you. What does this mean about your plans moving forward? Do you think Resy can be an app where you offer delivery as well?
That is an interesting concept that we're always looking into, right? How can we add more value to the restaurant and to the consumer? So there are multiple options. We're trying to really drive demand to restaurants. Just recently, we just announced with Amex, which is our parent company, a new Resy credit on some of our products, like the Gold Card and the Delta Reserve Card, right? So we're incentivizing people to go out and dine at these Resy restaurants because dining is an extremely strong passion area for card members.
New York City is about to start to clear out the stalls that restaurant owners put up during the pandemic, and that's going to mean fewer tables. I expect higher demand. It's going to be harder to get into the most popular restaurants. Is that good for you when it's harder to get in? Do people tend to use your app more, or do you like to see a lot of space, a lot of capacity?
We look for ways for people to discover that next restaurant, right? Like neighborhood gem that you might not know of, right? So we invest a lot in discovery. We invest a lot in driving more channels and marketing activities for restaurants to connect with those users. And those restaurants that join our platform are now part of this Resi network where they can also enjoy that incentive for card members to go and spend. And so always finding ways for restaurants to be discovered and to connect with new card members and Resi diners.
What about technology here too? We're getting an IB from a customer, and is it true here that the Resi app is more available on Apple phones versus Android? Do you have an Android plan moving forward?
Yeah, so today it's available on iOS. It's also available on web. We're working on relaunching an Android app, and that's on the roadmap for the next couple of months.
Is that because, I mean, is iOS a more important consideration because that's a wealthier consumer and more likely to be using your app? I mean, why didn't you do an Android app first?
We wanted to make sure that we had parity between the apps, and we're trying to build that back up. We used to have an Android app. The consumer needs have evolved, and we have introduced a number of new features on that app, and we want to make sure that when we release the Android app, it's just as great as the iOS one.
As Shonali mentioned, you are owned by American Express, and you've got, I think, a new promotion now for Gold Card holders. How important are those kind of promotions? I mean, when people are scrolling through what they can get with their whatever card they have, do they click and actually use it? Do you see follow through on that?
We see great uptake on that credit. So the way that it works is American Express is really focused on surrounding our payment products with membership services, whether it's travel, dining, and entertainment, and the connection with Resi is always important. Again, driving back demand to restaurants. So every card member on the Gold Card or multiple Delta cards enjoy that Resi credit. All they have to do is go onto their app, activate that credit, and every time that you dine at a Resi restaurant, that transaction will be eligible for that credit.
Fun fact, Matt, you have JP Morgan owning the Infatuation, Amex owning Resi. Clearly this restaurant, eating, dining, fine experience market is a big deal for the big financial companies. You've been owned by Amex for 5 years now. Where does this go from here? Ultimately, they like you because they have more offerings to give their customers, but what do they give you?
Yeah, dining has been a passion area for American Express for decades, right? Our card members are definitely, going out, trying restaurants, and really enjoying that dining experience. We are able to connect our restaurants with millions of card members through American Express channels, and that's demand back to the restaurants. That's revenue that goes back to the restaurants. The American Express card member, on average, spends more on dining than the non-Amex card member, and that's revenue that goes directly to these small businesses, right? And we want to help them thrive with it.
Pablo, we have to leave it there. That is Pablo Rivera of Resi, of course, the CEO there, in a very complicated market for the consumer. But they are, of course, still eating. Now, let's get a check on the markets here because they are, of course, ripping right now. You are seeing some weaknesses in some single-name stocks that had reporting earnings overnight and this morning. Those consumer weaknesses still concern to market investors, but not in the technology sector nearly as much. You look at today, 1.5% higher. Philadelphia Semiconductor separately also riding higher on the day. Very interested in the bond market here because you're seeing yields rising 3.93 on the 10-year and floating with 4% on the 2.
We are seeing a little bit of fade in terms of this buy because you had the SOX index, I'm looking now, up 3.75% at one point. And as you mentioned, every member was rising. Now it's only up 1.57%. So you're seeing the market give back a little bit of those gains earlier, but I do think it's interesting that you're finally seeing a little bit of divergence here.
Do you
in yields
remember
rise.
Monday?
Yes.
Feels like a year ago.
It does feel like a long time ago, but we had, real breadth to the downside there. And today we had real breadth to the upside. On the other hand, it's not quite as wide as it was. We were looking at 458 gainers. Now we're looking at 438 gainers. So not quite the strength that we saw in the first half hour of trade.
You know what has gotten stronger since Monday is Bitcoin. MicroStrategy owns 250,000 Bitcoin with an average cost of $36,000. We're going to discuss the notion of Bitcoin being a hedge against traditional markets. Some of that seemed to break down, but we're going to talk about it with co-founder Michael Saylor. Stick with us. That's next. This is Bloomberg. We're turning now to the crypto world because there's a notion there that Bitcoin is a hedge against the swings in traditional assets, but that seems to be breaking down. Bringing up a chart here just to show you the volatility over the last couple of months here. Gold has held stable, but Bitcoin has swung quite wildly around it, though the returns are similar in the past month. We're going to talk more about this, the rationale, all of it, with Michael Saylor, co-founder and executive chairman of MicroStrategy, the largest public corporate holder of Bitcoin. And Michael, first I want to ask you, in the last couple of days, you did see for a moment there Bitcoin fall below that $50,000 level. I do understand that MicroStrategy acquired an additional 169 Bitcoin for just over $11 million in July. But when you see that dip below 50,000, do you dive right in, and to what degree?
You know, we're always buying Bitcoin quarter by quarter by quarter. It's a long-term strategy. But the most important point for people to understand is that Bitcoin volatility is a feature. It's not a bug. The volatility creates tens of billions of dollars of credit and liquidity at all times, everywhere, to everyone in the world in the short term. But over the long term, that volatility is driving superior asset performance and durability. So it's volatile because it's functional. The other markets are all closed and they're crippled by the physics and the politics of the asset.
Isn't it a problem when a store of value, if someone wants to use Bitcoin as a store of value, can lose 10 or 20% over a couple of trading sessions?
The reason it moves is because it's functional. It's digital capital, and it's superior to physical capital or financial capital. Bitcoin's a capital investment you can hold for decades that a corporation, competitor, counterparty, or a country can't take away from you. So it'll create generational wealth for your family, your corporation, or your country. You can liquidate it at any amount, anytime, anywhere in the world, or you can hold it for any amount of time without active management or business acumen. So yeah, it's volatile, but it's so superior to every other option that you have for long-term capital management that I actually think the world is just waking up to discover this virtue.
Michael, I still feel the need to really understand the psychology of these pullbacks, because at some point it still matters the price you buy into Bitcoin at. How much are you willing to put to work when you see those dips? What types of dips do you look for when you put more money to work in it?
You know, we look at Bitcoin as cyber Manhattan, so there's never a bad time to buy up scarce, desirable real estate in the greatest city in North America. There's never a bad time to buy Bitcoin. So we will just generally acquire it, you know, whenever we have cash, whenever we can raise money in the capital markets, whenever we see the opportunity. I think timing the market is almost impossible for the mere mortal. It's time in the market that matters.
Another question I have for you, too, is even beyond MicroStrategy, how do you hold Bitcoin personally? Do you have a significant personal stack in addition to what you own through MicroStrategy and a MicroStrategy stock?
Yeah, I do have significant personal Bitcoin holdings. I think about 4 years ago I tweeted that I have 17,732 Bitcoin. I haven't sold any Bitcoin. I continue to acquire more Bitcoin, and I think it's a great capital investment asset for an individual, a family, an institution, a corporation, or a country. And I can't see a better place to put my money.
How much do you personally own today?
At least that much.
That's a lot. 17,000 is a lot. I was talking yesterday, Michael, to a young journalist, Andrew Chow. He's written a book called Cryptomania, Hype, Hope, and the Fall of FTX's billion-dollar fintech empire. He seems more convinced by Ethereum and the proof of stake method because he's so concerned about the climate and the environment. And a lot of younger people see it this way, that proof of work just takes too much power and is bad for the world. How do you respond to those concerns?
There are hundreds of thousands of investments that people can make, and I don't opine on any particular real estate, equity, or crypto investment. Bitcoin is special because it is literally the most powerful computer network in the world. It's the most powerful. It's got the most electrical power. It's got the most computer power. It's got the most economic power. It's got the most political power. The fact that it runs on 17 gigawatts or more of electricity means it's got more power than the United States Navy. That makes it nation-state resistant and nuclear hardened. So my view is if you're going to put away billions of dollars for decades, you're going to want a very powerful crypto network to defend it. And there really is no second best.
But it sounds like that much power generation is going to lead to, a higher global temperature, melting ice caps and rising seas. Like, when can it get carbon neutral?
That's a silly observation. People have been saying that for 5 years. Bitcoin's not boiling the ocean. It's like 10, 15 basis points of the world's energy usage. So it's de minimis compared to everything else. 30% of the energy in the world is wasted from some other source. So it's just guerrilla marketing and I think largely irrelevant and debunked at this point in time.
Michael, one thing I'm wondering about is, have you spoken to former President Trump? He's been talking about this idea of what it would look like for the U.S. to have a reserve of Bitcoin. Of course, the U.S. holds some Bitcoin through Bitcoin that has been seized. But what do you think about this broader idea more largely? Have you spoken to the former president about it? I know you have.
The future is digital. There's a race to own cyberspace. And we saw an entire set of politicians waking up to this. Senator Lummis has offered the strategic Bitcoin reserve legislation, and that's our Louisiana Purchase moment. Donald Trump has said, we won't sell our Bitcoin. And that makes BTC the apex property of the United States. The only thing that the nation won't sell are its national parks, its nuclear weapons, and it's Bitcoin. I think that the conversation has shifted and every politician in the world is starting to realize that Bitcoin's the most desirable property in cyberspace. It's the future.
Back in 2013, Michael, when Bitcoin was marching up towards 1,000, we started reporting on it for the first time, and I actually spent 2 weeks living only on Bitcoin, using it to buy gas and, beers at a bar down here and groceries at a place in Greenpoint. I bought my first one for $800, my second one for $600, and now I wish I hadn't spent them. Is there going to be a time when we actually use Bitcoin as a transactional, currency without regretting it so much later on?
I think if your grandfather owned a building in the middle of Manhattan and they sold it to buy a cup of coffee or some ice cream, you would have regretted that too. Yeah. Half of the wealth in the world is just long-term capital. Call it $400 or $500 trillion. People just want to keep their wealth. They want to hold their money for decades or generations. Bitcoin is capital. And if you think of it as capital, the most desirable capital in cyberspace, then the right way to consider it is the same way as if your family owned a sports team or a trophy asset or a Da Vinci painting or a building or all the land in Palm Beach. You would hold it as long as you possibly could. You would finance it, and you want to buy a cup of coffee with it, borrow some money from a bank, spend dollars, spend pesos, spend euros, but keep the most desirable property in the universe.
All right, Michael, thanks so much for joining us. Michael Saylor is MicroStrategy Executive Chairman and co-founder. He owns at least 17,000 Bitcoin. And of course, MicroStrategy always continues to add to its giant Bitcoin pile. We have some breaking news now, updates on efforts for an Israel-Hamas ceasefire. U.S. National Security Council spokesman John Kirby is speaking to reporters, and he just said, quote, "We are as close as we've ever been to a ceasefire between Israel and Hamas," since obviously October 7th. A note in terms of Hamas, yesterday named Yahya Sinwar as its political chief, who is one of the key masterminds of the October 7th attack. We'll continue to bring you any developments there. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. This is Bloomberg. Time now for our trading diary, what you need to be watching this week. We're going to get U.S. consumer credit numbers this afternoon, so pay attention to the EcoGo function on your terminal. Earnings from Robinhood and Warner Brothers Discovery after the bell.
And we're going to talk to the CEO of Robinhood tomorrow as well. We're also going to get tomorrow morning earnings from pharma giant Eli Lilly and economic data, including initial jobless claims. That will certainly be one to watch. We will also hear from Richmond Fed President Tom Barkin at 3 p.m. Eastern Time. Let's go check on these markets, Matt. They've been interesting this morning. Of course, we've seen a pretty strong bid in the market, 1.5% higher in the S&P 500, 1.8% higher on the NASDAQ 100. We had some serious breath, but as you've been pointing out, it has been wavering a little bit throughout the morning.
Still pretty strong, though. Right now I'm looking at the move function on the terminal. 444 stocks up, 57 stocks down. So that's real breadth in this rally. 1.5% added to the 1% we got yesterday. Still doesn't make back the 3% that you lost on Monday. But we're back at 53.18 on the S&P 500, and we're seeing bigger gains in the tech stocks. As you see there, the NASDAQ is up 1.8%, and as you've been pointing out, the SOX index is a gainer as well. It was up almost 4% a little bit earlier. Right now, the SOX index is gaining 2.25%.
A lot of red on the screen. Airbnb, Lyft, both still down more than 12%. A lot of worries about that consumer. Disney only down now about 1.4%. Novo Nordisk down more than 6.4% in Denmark, of course. And a tough day there for some stocks, but a better day for the market. Looks like the rotation trade is out of bonds and into equities.
Yeah, I think it's really interesting that you're seeing all of this kind of disappointing news on the consumer. Not booking as much at Airbnb as expected, not going to Disney parks as much as expected, not on TripAdvisor as much as expected. Coming up on Open Interest, join us for the C-Suite interview. As Sonali said, Robinhood CEO Vlad Tenev joins us tomorrow.
heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from San Francisco, this is Bloomberg Technology. Coming up, I sit down with the CEO of Lyft, president of Shopify, and COO of Reddit, and we break down those companies' earnings results. Plus, we stick with earnings as Airbnb sees a record plunge on a weak outlook. And we dig into Disney as the Mouse House offers a mixed picture in its earnings. Let's check in on the markets. The NASDAQ 100 up for a second consecutive day by... Actually, no, I take that back. I'm wrong. It's down 0.2%, how things can change in a session. The story right there is really about monetary policy. You know, and on a 3-day basis, we're flat. We're slightly higher in the session. We're still thinking about Monday and the sell-off that happened on growth concerns and monetary policy intervention. So overnight, the Bank of Japan basically said, we won't intervene with a rate hike in the event that markets are unstable. And that's kind of having it not much to do with tech. There's one big tech name that is moving, and that's Airbnb. Check out this chart. So in the session, Airbnb is on track for its biggest drop ever. We're worried about the outlook. We're worried about what Airbnb had to say about its peak holiday season, even though some executives took to the social medias to tell us things are all right. Let's talk about Airbnb and bring in Bloomberg's Mandeep Singh, senior analyst at Bloomberg Intelligence. So what they said was moderation sequentially of growth. And the growth wasn't that good in the quarter gone. So if you extrapolate, you're basically saying, hold on, this is the best time of year normally for Airbnb, the summer months. We're worried about what they're saying about business traffic.
Yeah, look, and you're right. I mean, given it's Olympics and, you know, a lot going on in terms of holiday planning, they talked about shortening booking windows. And to me, you know, the biggest risk with Airbnb is not that they don't have a great moat. It's more about the saturation in the alternative accommodations market. And whatever new products that they have launched, whether it's rooms or experiences, which they have had for a while, hasn't really driven incremental growth. So what they told us last night was, look, the room night growth will be mid-single digit and EBITDA growth will actually taper off because they plan to invest more to expand supply in new areas in Latin America and Asia Pac. And I think all those are signs towards, you know, penetration being high in their existing markets, and they just have to find new markets if they want to keep growing in alternative accommodations. Or perhaps they need to make an acquisition, which I won't rule out given the strength of Airbnb's balance sheet.
Okay, so Mandeep, your stock's down 12 to 14%, the most on record. What do you do if you're the CEO? You go on social media and say it's a great time to buy. Would you agree with Brian Chesky's thesis here?
I mean, he had a floor last night and during the earnings call to talk about the plans, and nothing we heard was very exciting. Look, long term, as I said, this company has a great moat. It clearly is a category leader in alternative accommodations, but can it keep growing double digits? And I think there are question marks. They can do it at least in the next 2 to 4 quarters.
Bloomberg's Mandeep Singh at Bloomberg Intelligence. Thank you. I want to get more on the market outlook as equities trade broadly in the green with Bloomberg's Emily Grafeo. I don't know about you, Em. I'm kind of recovering a bit from Monday still, the trauma of a near 3% decline on the NASDAQ 100. But in the market, there's the growth concern, there's the central bank policy concern, and then there's probably earnings. What's the outlook of all of that in aggregate?
Well, Ed, the outlook is that the volatility is not expected to subside, even though we are seeing this market rally yesterday and at least today. When you look at the VIX volatility index, typically when we see a spike like we did on Monday, that means that for the next several trading sessions and even up to weeks, we'll see these big up days and these big down days. What's interesting, this is Bloomberg Technology. We had been talking so much about a rotation into smaller cap names, value names a few weeks ago, and we're actually kind of seeing that trade disappear now that markets are rallying. Technology stocks are rallying the most. You look at the NASDAQ 100 at least today, up almost 2%. The Russell 2000, which was outperforming tech, is only up about 0.8% right now. So, a few days ago, we were talking about, is tech no longer a safe haven? Is that no longer a place that investors want to hide? But it actually seems like we are still seeing an appetite to buy those mega cap tech stocks.
And we remind our audience, NVIDIA doesn't report until August 28th, and everyone's kind of treading water till that point. Bloomberg's Emily Griffeo, thank you very much. Aside from this week's massive sell-off, some of the world's biggest equity hedge funds lost hundreds of millions of dollars from piling in to popular tech stocks amid the stock rout that hit markets in around mid-July. Bloomberg's Hema Palmer has been tracking it. There are some specific single names in that industry who were probably more hit than others. Who are they and what happened?
Yes, so we saw a lot of pain over at Light Street, down 9% in 1 month alone of July. Still up 40 for the year, but definitely a difficult month for them. That's likely due to their very big position in NVIDIA. As of March, that stock accounted for about 17% of their portfolio. They also have sizable stakes in other of the Magnificent Seven. When we look across the world, the hedge fund space, specifically when it comes to the equity funds, you do see this concentration in Microsoft, Amazon, NVIDIA, and some of the other big tech names that have really struggled this month.
Bloomberg's Hema Palmer with the data and the hedge fund ownership of big tech. Really appreciate it. Thank you. So coming up on Bloomberg Technology, we're going to be joined by Reddit's COO, Jen Wong, to discuss the company's results and their outlook for sales growth. An interesting conversation. Jen really at the heart of some of the deals that Reddit is doing. One other name that I'm looking at is in the chip sector, Micron in particular. Let's bring up the stock and take a look at it. There's several stories out there, one largely around share buybacks. The company basically saying that they may resume a stock buyback program to offset some dilution from their employee stock comp programs. The stock up 2.7%. Remember, we've covered this really in the context of high bandwidth memory recently, but also it's one that is in a lot of end markets, smartphones, DRAM and NAND flash being one as well. This is Bloomberg Technology. Reddit beat analysts' expectations on sales growth after expanding its data licensing partnerships and investing in new advertising technology. The company's revenue forecast for the third quarter also beat estimates. Delighted to say that Reddit's COO, Jen Wong, joins us live here on Bloomberg Technology. You know, the stock is lower, an impressive set of numbers for a relatively newly public company, and everyone's kind of looking at the outlook and trying to extrapolate out, understand the world that Reddit's operating in. Could you just give us a sense, Jen, in your conversations with advertisers, what the rest of the year looks like, the environment looks like, and why Reddit may or may not fare better with those advertisers compared to other social media platforms?
Yeah, thanks for having me. Look, the markets are the markets, but when we look forward to the back half of the year, I think advertising is a pretty stable market. And what drives our growth is what drove our growth in Q2, which is delivering against our consumer and ad roadmap and continuing to drive value for advertisers. So I think what's driven our user growth has been the work of making Reddit better, making it easier to access posts, easier for people to connect with communities, easier for mods to do their moderation. And that when we make the platform better, the users grow. And from an advertising perspective, it's been all the investments we made in our ad platform to improve usability and scalability so that we can address and serve more advertisers and grow the advertising base. Next is delivering quarter-over-quarter performance for our advertisers, and then delivering things that only Reddit can do, that are Reddit unique, like the Ask Me Anything format refresh, or testing things like ads and comments. Those strategies are working for us, and we'll continue executing against that roadmap as we head into the back half of the year, and we feel really good about the yield on that roadmap.
Okay. Jen, you've been very busy since last we spoke. I think principally about the deals with NBA, NFL. What I'm trying to understand is how those kind of video-focused partnerships contribute to your ad revenue or ad growth going forwards from this point.
So Reddit is home to an incredible group of fan communities, and the sports communities are some of the most active and engaged on the platform, and that they're global. And so the idea of having those partnerships with the sports leagues was to bring in special content like highlights, like access to players for AMAs or to insiders for those communities to enjoy. So that is really our starting place for it. Now, what's great is that it does create an opportunity for advertisers to support that content. Some of those advertisers support that content and are aligned with that content on other platforms like television, et cetera. So it is a really nice win-win-win for users and communities and Reddit and advertisers. It's early. It's a program that we're testing, and we've done some work with the NFL. Now we've expanded it to more leagues. We are excited about it because I think the communities are excited about getting access to that content. And if you think about it, you know, we've done partnerships with U.S.-based leagues, but there are so many more sports and so many more global leagues that we could engage with. And then the fan communities, they really go beyond sports on Reddit. They're deeply
Jen,
meeting.
I am a long-serving, suffering and passionate Chelsea fan in football, what you'd call soccer, and I dive deep into Reddit when I want to see what the fan base wants to know. You and I have discussed previously licensing of data to the AI companies, Google, OpenAI, but a few months have elapsed, and I'm wondering if you now have a better sort of vision for the long-term potential of that business model away from advertising.
Look, I think that landscape is still emerging. And it's still early days for AI. So it's a long arc. We've been, I think, very thoughtful about how we structure partnerships. Our view, they're not 1 year, they're not long term, they're sort of midterm partnerships that allow us to learn and find a way to work with this new area and see how it goes. So I don't think, I think we still continue to learn in this process because I think it's a very long arc. I do think some of the things that we've done have established a foundation for having these partnerships. So if you look at our public content policy and you look at the changes that we've made. I think we've made it really clear how we want the ecosystem to work because we are stewards of Reddit's data, and user privacy, et cetera, is really important in allowing scaled access to Reddit data.
Yes. Jen, when I sit at my computer in the morning, I use various search functions. It's often a Reddit post that will come up. It's quite easily discoverable, specifically Google search, but going forward, ChatGPT, there are platforms where that's not the case. Bing. Do you have a clear strategy for search expansion for Reddit content?
I mean, look, we have been beneficiaries of the open internet. We believe in the open internet and allowing people to get access to important information. And Reddit's corpus has some of the best and most important answers regarding everything, product, services, life, et cetera. So we want Reddit to be open, but we have to have a set of rules for doing that. And search and summarization and AI and data usage, they're sort of all merging, right? This is part of what's changing in the world right now. So I think our view is we will have a conversation with anybody about having access to the data, but we've been very clear and transparent about our rules, which are our public content policy and protecting user privacy as being good stewards of Reddit's data, and that we have to have a conversation where those policies and rules are respected, and then there's commercial alignment. So we're having conversations with every player, large and small. Okay. And I think we've made it clear, that what the rules are and how to make this work. And the fact that we've signed deals, I think, is a sign that we're sensible. There's a path here to do that.
Jen, the stage is now very much set for a presidential election race for November. How does that impact Reddit? Do you kind of foresee boost from political ads or even just activity on the platform centered around the election?
Yeah, we actually are not a big player in political ads. We never have been. Politics is obviously a big area that our communities engage with on Reddit, so we do see conversation. But what I would say is on Reddit, because we have so many diverse communities, different communities have moments at different times. This is a presidential election year, so politics is, going to be a little bit bigger, but then Olympics was a little bit bigger, and then there are seasons where other communities kind of have their moment. What happens with Reddit is that kind of smooths out over time. So a community might be having a moment at one time, then another community, then another community. But if you look at the arc of Reddit's growth, it sort of is all smoothed out over the trend.
Reddit COO Jen Wong, it's great to have you back here on Bloomberg Technology. Thank you very much for your time. Now, coming up on the show, we're going to break down Shopify's earnings results with President Harley Finkelstein. That's coming up next. Back to kind of AI and the service space. Look at shares of Supermicro, down pretty significantly, 16%, having initially surged in after hours. Revenue and profit missed estimates in the quarter, but they gave an outlook that was like billions of dollars above what the street was expecting. I think the market's just trying to make sense of like what's happening. Remember, Supermicro basically assembles the servers that go into rows in data centers. Interesting move. This is Bloomberg Technology. time for Talking Tech, and in the news, SoftBank announces a $3.4 billion buyback. The Tokyo-based firm said it would purchase up to 6.8% of its free-floating outstanding shares through August 7th of next year. The move comes as CEO Masayoshi Son prepares for a large-scale push into AI and semiconductor investments. Plus, Hewlett-Packard's $14 billion deal to buy Juniper Networks gets the okay from UK watchdogs. The Competition and Markets Authority cleared the purchase after investigating if it would lessen competition in the UK. The deal was similarly passed just last week by the European Union. And Sony raises its revenue and profit forecast for the fiscal year to March. The company saw a successful quarter in its music and gaming divisions, with operating profits at $1.9 billion. Its PlayStation division saw a lift, but its PS5 consoles sold just 2.4 million units, significantly below the 3 million units that analysts had expected. Let's get back to the earnings story and take a look at Shopify. The global commerce company reported earnings results before the opening bell this morning, beating estimates. Shopify President Harley Finkelstein joins us now for more. Good morning to you, Harley. It's good to catch up and have you back on Bloomberg Technology. Things are going right for Shopify. The environment's hard to understand. Is there something specific that Shopify is doing better or well in that environment?
I think so. I think absolutely. So first and foremost, I think we've earned the trust of millions of merchants and businesses all over the world. We announced, a month or so ago, I announced that we have now powered over $1 trillion with a T in cumulative GMV since our inception, which for us is really incredible. But I think we're not just helping merchants compete. I think we're propelling them to victory. And in terms of how Shopify is doing, in particular, I think these results demonstrate that we can create this serious combination of both growth and profitability. When you exclude the sale of logistics, revenue is up 25% for the quarter to $2 billion.
Yes.
That's our fifth consecutive quarter of at least 25% top line growth. When you look at free cash flow, our free cash flow margin more than doubled from last year, from 6% to 16%. Now, in terms of sort of the more macro, sort of macro questions you're asking, look, from our vantage point, I'm hearing from other companies, which you're hearing as well, but from our vantage point, our merchants, the merchants on Shopify, are outperforming others in the market. They're growing at healthy rates. We're adding more merchants every day, and I think as a result, we're gaining more market share.
Harley, real quick, I just want to jump in because it did go well for you in the quarter. You've kind of been suffering from slowing growth in prior quarters, and your emphasis was on marketing, but something jumped out. You talked about a partnership with a social media platform that really helped out. What platform was that? What were the specifics around that as a catalyst for you?
Yeah, I mean, the truth is, the way that we think about marketing is the same way we think about product ed. We don't necessarily, it's all about data. And so when we see a particular marketing opportunity, we take that opportunity. And the way that we think about all our marketing channels is these are levers. So in Q1, we did an experiment with a new emerging marketing channel, emerging social platform. We put some money to work. We saw a great return. We doubled that in Q2, and we saw about a 51% increase in new merchants from that channel. At the same time, we saw other channels that historically did perform well, not perform as well, and so we pulled back on it. But the way that we think about our marketing is as this incredible data-driven engine that allows us to not just focus on SMBs in English-speaking countries, but you think about our point-of-sale business, our B2B business, our international business. We're able to deploy capital to have the highest return on those investments, all within an 18-month average payback. And that's the sophistication that we've built into the growth levers of Shopify.
So which big social platform was it?
We don't go into specifics on that. It's just an example of something that we're constantly experimenting with. There's not that many emerging social platforms, so I'm sure you can figure out which one. But the point actually that we want investors, we want the street to take away is that we are always looking for new ways to grow the business. And again, 5 consecutive quarters of above 25% top line growth while being profitable. There's not too many companies that can do that at our size and grow their market share. And I think this is the best version of Shopify you're seeing right now.
I've spoken to so many businesses, small and slightly bigger, that use Shopify. I get the benefit of it. So this is about discoverability, right? Adding new merchants or markets to your platform. But let's do the math. If we won't name the social platform, what ballpark was the spend? Because the return on that campaign seems to have been very definitive in the quarter.
Well, think about this. When we started we've been public now for just over 9 years. Initially, we were focused on e-commerce for SMBs in very specific regions. We now have a point-of-sale offering that surpassed $100 billion in GMV. International, for example, over 50% of merchants that joined in Q2 on Shopify were from outside our core English-speaking countries. 2 years ago, we didn't have a B2B product, and this past quarter, B2B GMV grew 140% year on year. So it's not just getting more people to use Shopify, it's more people in more geographies to use different products, and that is leading to the growth that you're seeing at the same time as being focused on profitability.
Harley, we enter the summer months and then we have the holiday season here in North America. Do you kind of market hard in the summer in the hopes of having business transaction later in the year? Real quick.
Look, I think the key is that I do think the holiday will be very good, but because we have so many different verticals of merchants, we have, Figs doing scrubs and pet products from BarkBox. We have Nestle and Heinz and Mattel and Staples all using Shopify. We're not relying on one particular type of merchant, but I think the merchants that are on Shopify are doing disproportionately well.
Harley Finkelstein, president of Shopify. Great to have you back on Bloomberg Technology. Thank you so much. So coming up on the show, we're going to hear from Disney's CFO, Hugh Johnston, on the company's earnings results, an interview on Bloomberg Television earlier today you do not want to miss. This is Bloomberg Technology. Welcome back to Bloomberg Technology. Ed Ludlow here in San Francisco. Disney gave a mixed picture as it reported third quarter results, with weakness at its famed theme parks, though it made its first ever profit in streaming. But with so many bundles, are consumers getting streaming fatigue? Disney CFO Hugh Johnston joined Bloomberg earlier. Listen to this.
Consumers do seem to appreciate having a limited number of bundles. Now, what we've tried to do with our own offering is offer the individual pieces, or if people want to get a discount by bundling more, we're happy to do that. So that said, I think you do see a trend where there's probably going to be a few big competitors in the marketplace in streaming, as we see right now between Netflix, Amazon, and ourselves. And then there'll be some smaller competitors out there, and they'll have to decide how they're going to run their businesses.
Are you concerned that consumers right now potentially are going to shrug off the price increases? Because what we hear from a lot of companies is that we do see consumers trading down. Why do you think they're willing to pay for a higher price point?
Well, I think the biggest reason is it's always important to focus on this. The consumer receives value, and what they pay is price. And because we're delivering so much value, I mean, really an enormous amount of value in terms of the hits that I just mentioned. But then in addition to that, the combination of Disney Plus, Hulu, and then we're going to have an ESPN tile and ultimately ESPN flagship on our streaming service. That's a huge amount of value for consumers. And as they're allocating their entertainment dollars, I think they're going to view us as a great place to put them.
That was Disney CFO Hugh Johnston. Take a look at Disney shares. We're off session lows, but we're down 1.9%. The company also commented on its negotiations with Hulu in a filing today, saying it may have to pay $5 billion more to acquire Comcast's 33% minority stake in Hulu. The two sides have disagreed over the fair value of Hulu and entered into arbitration proceedings. The stock, by the way, down 2% so far in the year. Let's discuss all of this with Lightshed partner Rich Greenfield. Let's park Hulu for 1 second. First ever profit for streaming. Is this the Rich Greenfield slow clap, or are you not so overwhelmed by that news?
When you see subscriber growth slow effectively to a halt, and the price has gone up pretty dramatically, it's pretty clear. I guess in many ways it's sort of this, hey, we don't know how to get more subscriber growth, so we'll raise the price and, hope that people won't, and we'll even cut back on programming. There's obviously a lot less programming. Disney's essentially going to rely on their movies to drive the streaming service and hope that the movies are strong enough when they flow to the streaming service that people don't cancel. Because they're not expecting a lot of growth in subscribers over the next few quarters. And so it's basically trying to, get to profitability, drive profitability of the existing base. But it doesn't really seem like there's a tremendous growth story here. And I think that's sort of, look, everyone's focused on the parks. I don't think anyone's really focused on Disney Plus at the moment. The streaming is a nice data point. I think it's less about getting to profitability and how big a business can this actually be, Ed? Can this be a multi-billion-dollar free cash flow generating business the way Netflix, or is this, going to essentially tread water, at a low single-digit margin? I think that's what investors are really going to focus on over time.
I mean, you and I have discussed in the past, right, achieving profitability by cutting cost out of the equation. So let's bring it back to Hulu.
What you really want to see is people. You really want to see people who are so passionate. They love this service. They're willing to pay more because they're spending so much time. You want to see consumer love. And based on that love, you can keep raising the price, getting more people to subscribe because there's great buzz and word of mouth. That's not what's happening here, nor any of these other streaming services.
So then let's talk about Hulu. I just finished Star Wars Acolyte on Disney Plus, and like everyone else, I loved The Bear on Hulu. We did the reporting on the negotiations for the remainder of Comcast's stake. Is it important if the idea is to achieve volume and get stuff that people want to watch? Do you see Hulu as being a sort of something that needs to be resolved as part of that?
I mean, Hulu is going to be resolved. We're just talking about the number now. And I think investors are, expecting several $billion, whether it's 4 to 5, we'll obviously see. But I don't think this is, I think obviously probably Comcast would love more, Disney would love less, but I don't think investors are stressing over what this number ultimately is. Investors are just surprised that the option was exercised last October. I think it's sort of crazy that we're still talking about this not resolved here in August.
Rich, if you could ask one thing of Bob Iger or give one piece of advice to him to fix this in a way that you think would be positive, what would that be?
Look, I think the bottom line is if Disney is really serious about being a long-term, and you heard Hugh saying they're going to be, in the clip you played earlier, if they want to be a long-term winner in the streaming game, it's not about discounting through bundling. It's not about cutting back on marketing. What they really need to do is invest very aggressively. Stop playing this near-term Wall Street game of trying to get earnings growth. They need to invest aggressively in making great content all the time that gets consumers to engage with the Disney streaming platforms every single day for hours a day. Like, that should be their North Star, versus trying to figure out alternative ways to manage churn. That's what we'd like to see. And look, you've got all of these theme park concerns that are sitting with the company right now. Like, that's what investors are really worried about, is how did the theme park slow down this fast in the span of just the last few months when Disney historically has pretty good visibility?
Rich, I want to get some time to talk about another name, Reddit. We had Jen Wong, COO, on the show earlier. Very sort of patient, sanguine, calm about the ad environment, but sees a lot of opportunity in sports. I know that you like that name a lot.
We do. I mean, if you think about what Reddit is, they really understand what consumers are interested in. And they've got one of the biggest companies in the entire world, Alphabet Google, is in their corner. You can't do a Google search and not see Reddit results rising higher and higher and higher. Google's paying them for AI. Like, Google is a firm believer in Reddit. If Google believes in Reddit, everyone watching this show and investing should believe in Reddit. Like, I think that is a really important data point, is that there is this increasing visibility Reddit's getting within Google. And Jen Wong, who is now building out an ad business, Reddit was very slow to get going. They've got it going now. And we've seen other companies, whether it's Snap, Pinterest, go back, X, which used to be Twitter, when those companies crossed $1 billion, getting from 1 to 3 can happen very, very rapidly. And especially at Reddit, where they really know who you are. They don't need third-party cookies or data. They know exactly who Ed and Rich are. They have all of this interest data because you are searching Reddit for a topic, whether it's the Giants or whether it's video games. Like, they really know who you are, and it allows for really well-targeted advertising. I think Reddit is a must-own stock. We just put a buy on it with an $84 price target. I know people are worried about the lockup ending on Friday. It is a great opportunity. People are going to regret not buying it today.
Lightshed partner Rich Greenfield, really great to have you here on Bloomberg Technology. Really appreciate it. Thank you. So coming up on the show, we keep the earnings conversation going with David Risher, the CEO of Lyft, discuss the company's earnings results, which reported before the opening bell this morning. Timely. This is Bloomberg Technology. let's get back to earnings and Lyft. The rideshare company reported before the bell this morning. CEO David Risher joins us live from New York City to discuss. And the basics of it are that bookings, the outlook missed estimates or street expectations. The stock is down significantly. What is happening right now with Lyft, the environment that Lyft finds itself in?
Yeah. So, hey, Ed, it's good to see you again. I mean, look, to me, it's a little curious, right? And this is sort of the way the world works sometimes. So we just had our first profitable quarter ever, which is an enormous accomplishment, thanks to a lot of work with the team. Revenue grew 40% year on year, bookings and rides around mid-teens, 17%, $256 million of free cash. So, and service levels that are fantastic, fastest pickups we've had in a long time, fastest or more drivers than we've ever had. So all those things are incredibly strong and they indicate a strong marketplace. And we reiterated our full year guidance and our multi-year guidance as well,
yes,
mid-teen growth. So all those things are good. I think what people are looking at is they're seeing what I would consider to be, incredibly small, sort of kind of adjustment around what we've said about the future, the next quarter, the next couple of quarters. And this to me sort of signifies, sort of the world we live in. Like the things that we think about are 160 billion rides in the US in total, private cars. And we are little by little, in a very, very disciplined and customer-obsessed way, growing our business. I think Wall Street sometimes looks at short-term things and gets a little bit overly focused on that. I'm thinking about the long term and super excited about the prospects.
David, there's some David Risher strategy and plans that I see playing out, like Price Lock, a paid feature. That's going to have an impact maybe on the top and bottom line, but why is that the plan for you?
Yeah, so Price Lock is a way for riders to lock in a price, just like it sounds like, on the same route and same time every day. It's really meant for commuters. And it's available today, by the way. I encourage everyone to check it out. It's kind of in soft launch. And the idea is it takes away that what I think is one of the most hated features of all rideshare, which is surge pricing, right? And we're sort of trying to get rid of it. We can never get rid of it completely, but we can certainly give riders a way to basically pay a small subscription fee and lock themselves into a consistent price. I think it's great, and I think it's the sort of thing that's going to grow the business in the long term. Of course, it's an investment, right? And you always, invest in new features that you have a lot of conviction around. But this, again, is our customer obsession, is what drives profitable growth. Okay. Again, we're profitable now, and we think this is going to be a great growth driver for us.
Advertising is a battleground as well. I am so familiar with the Lyft app, but why is advertising the way to go? And with who, with what, right? You think about parallel industries.
Yeah. So, think about, of course, let's zoom way out for a second. Since the history of advertising, brands have tried to come up with new ways to talk to their consumers, right? And 100 years ago, maybe it was billboards, then maybe it was radio ads, then maybe TV ads, obviously more recently, internet advertising. We see this kind of mobile advertising, literally advertising that comes to you in the car where you're going, as an incredibly important, effectively a sector that we're really going to help build out. And because if you think about it, and reflecting on some of the earlier conversations you were having around Reddit, for example, we have an enormous amount of first-party data, right? 2 million rides a day, every one of them going to a 7-Eleven or a Starbucks or a, whatever it might be. And that's first-party data that's very indicative of what it is that riders want to do. And so our media business has grown significantly. We're up significantly year on year. And we're really optimistic that it's going to be a whole new form of advertising and media that'll go super great.
David, when I reported that Tesla was delaying its robo-taxi event to October, the shares of your company jumped in that session. The Vision is a proprietary app from Tesla for ride-hailing, but a fleet of cars that drive themselves, Teslas. Your stock went up on the basis that everyone was like, okay, the competition from Tesla's not yet coming. Just your latest thinking on that, please.
Yeah. Look, I think AVs are going to be great for Lyft. I really do. And I think it's because we're going to be the best way to commercialize what is a very, very expensive asset. Different companies will try different things, but I think largely you'll have a lot of OEMs doing a lot in the AV space and wanting them on our platform because of millions of rides, all the technology we have to incorporate cars in our platform and so forth. I don't want to comment on Tesla. I don't know. We'll see kind of how that goes. But I do think that creating your own thing, a kind of closed network, it's a fraught strategy, and maybe a different strategy would be to figure out a way to get your cars that you've built and your technology, as broadly available to as many as possible.
David Risher, the CEO of Lyft, thank you so much for joining us in the studio in New York. Thank you. Now, shares lower of Rivian after the EV maker's second quarter revenue missed analyst estimates just. Cash burn for the quarter came in bigger than expected. Earlier, I sat down with the CEO, RJ Scaringe. Listen to this.
We see that both through the excitement of our customers directly, but there's lots of ways to measure this. And we just had J.D. Power does an annual appeal study. We came out as the number one brand this year. We had a number one ranking on a J.D. Power study last year. So the reaction of the product's been great. We've in the second quarter, we went through a big refresh to the product where we've now launched what we call Generation 2 of that vehicle, of the R1T and the R1S, where we made significant improvements in the product, but also took a tremendous amount of cost out of the vehicle.
RJ, the kind of summary of the earnings print was that all of the guidance previously issued was reiterated, and there's a lot of positivity around that. Very simply, loads of people asked me to ask you, can you define what modest gross profit means, or what you're defining it by in order to achieve it?
Yeah. I mean, ultimately, this has been the central focus for us as a company, as a business, is driving cost efficiencies into everything that we do, into our bill of materials, into how we operate and run our plant, and ultimately driving towards getting our production of our R1T and R1S to positive gross margin, ultimately to have the business get to positive free cash flow and profitability. So there's a whole series of steps we're making along the way in terms of improving costs, but the biggest singular step that we've made is what we did in the second quarter. We took the plant down for about a month, where we made meaningful changes to the operations, and importantly changed a significant portion of our supply base out to new suppliers in conjunction with a number of design improvements. And all of that comes together to take us to a place where the incremental contribution of every vehicle we sell is positive, and that's that's what we're driving towards. That's where we continue to guide towards for the fourth quarter this year.
In the first instance, sorry, Matt, I was just going to hold RJ to account on that one and say, in the first instance, is it just like more than zero, or single digits gross profit? I think that's the answer we're looking for.
We haven't provided a specific number, but certainly by saying it's positive gross margin, it's more than zero. Our objective, what we've guided to for a long time, we continue to maintain this guidance, is the long-term margin profile on R1 should be around 25%. And so that's what we, beyond just this fourth quarter performance that we're tracking towards, seeing how we continue to improve in 2025 and beyond, we still maintain confidence in the 25% gross margin.
My interview with RJ Scaringe, the Rivian CEO. Meanwhile, Tesla will release a software update to most of the cars it's ever sold in China due to an issue that could leave an unlocked hood unnoticed, creating a potential safety hazard. Tesla will deploy an over-the-air software fix to more than 1.6 million imported Model S and Model X vehicles, as well as Model Y and Model 3 that were produced locally. Okay, coming up, social platform X files a lawsuit about an advertising boycott. We have those details next. This is Bloomberg Technology.
I was shocked by the evidence uncovered by the House Judiciary Committee that a group of companies organized a systematic illegal boycott against X. It is just wrong, and that is why we are taking action.
That was Linda Yaccarino, the CEO of X, after the company filed a lawsuit accusing an industry group of violating antitrust laws for an advertising boycott that cost the social media company billions of dollars, it alleges in the filing. Let's bring in Bloomberg's Kurt Wagner. An advertising boycott sounds severe. Federal filing in a court in Texas. Just explain the very basic accusation that X is making.
Yeah, I mean, the claim is that this group, this industry trade group for advertisers, essentially, did anti-competitive behavior, right? They came out and they advised all the members of the group not to spend on X, kind of created, as Yaccarino said, a boycott of the business. And they're claiming this is illegal. Now, I don't know exactly what an illegal boycott is versus a legal one, but Ed, you and I have seen boycotts of not only advertising, but products all the time, right? This is usually the way that consumers or businesses sort of voice their displeasure with someone, which is what happened in this case shortly after Elon took over. I don't really know whether this lawsuit will succeed for them, but I think what they're doing here is sending a huge signal that, one, the business is struggling, they need to do something about it, but two, they're clearly picking a fight with the broader ad industry right now.
We're showing some more of the comments that Linda Yaccarino made. It was interesting, the video posted to X, Elon Musk amplified it. I guess the context is that X has been suffering in terms of revenue or financially in the period since Musk took over and Linda Yaccarino was appointed CEO because of this. I'm trying to understand why they would take action.
Well, that's exactly right. They're saying that, look, this group is, collectively getting everyone riled up to intentionally hurt X's business. Now, I think what's sort of interesting here is what does this ignore? Well, this ignores Elon's own behavior, right, which we have talked about on the show several times over the last, couple years, right? You may recall, Ed, late last year went on stage at a conference and told advertisers to go F themselves, right? He has been very proactively aggressive to certain advertisers over the years. And so while they are saying, well, hey, look, this group is illegally creating this boycott, it doesn't take into account the fact that, some of this decision making may simply be because people don't want to work with Elon given the things that he's done and said to them.
Bloomberg's Kurt Wagner, thank you. I mean, a complicated story. There will be a legal process. We'll follow it here on Bloomberg Technology. That does it for this edition of Bloomberg Technology. Another busy day of earnings, fantastic interviews with executives from across the world of technology. Recap on the podcast. You know exactly where to find it on the terminal as well as on Apple, Spotify, and iHeart. Cue the beautiful pictures. This is Bloomberg Technology.
Welcome to Bloomberg Markets. I'm Scarlett Fu. Turnaround Tuesday extends to Wednesday for stocks. The S&P 500, the Nasdaq, and the Russell 2000, by the way, all posting back-to-back gains, clawing back some of the losses from their three-day sell-off. Now, when you look at treasuries, they're also building on yesterday's momentum. Prices down, so yields up. The price down results in a red color here, but yields up is the red arrow going up. And the 10-year, notably, is just below that 4% mark. Dollar, yen, and currencies, this is where the real action is. The yen is the biggest decliner among G10 currencies, in fact, major currencies, after the Bank of Japan's dovish signal. We'll get into all of that a little bit later on in the show. But first, we want to drill down into some midday movers. And Abigail, stocks are up, but they're just near session lows. What can you tell us?
Well, here are some of the reasons. Other stocks that are down that we could be near session lows, even though stocks are overall up. We are, of course, having lots of earnings come in. Take a look at the shares of CVS, down about 1%. This after they slashed their outlook again. They have launched $2 billion in cost cutting, but they've been having such a rough time over the last year or even longer. Shares responding poorly. Disney down 1.9%. This as parks grew just 2%, a slowdown in parks, pointing to some fatigue on the part of consumers, frankly, offsetting some of the gains for streaming. Novo Nordisk down 7.9%, squeezed their revenue squeezed by PBMs, or the pharmaceutical benefit managers, around Wegovy, that hit drug pricing. Investors clearly not liking that with that stock down so much. And then Airbnb down 13%. Its worst day ever. They missed sales. They missed bookings in the quarter that was, and the outlook is weak. So this is a snapshot of some of the stocks that aren't working. Let's take a look at what is working, helping out some of the indexes. And actually, this is one reason why we are off the lows. We'll get to it in a moment. That's NVIDIA. But first, Lumen Technologies up 30%. They put up a great quarter. Their free cash flow outlook also very good. There's a 14% short interest, so I suspect that's some of the move. Fortinet, its best day since 2009. The cybersecurity company put up a great quarter. The outlook, so a bit of a relief for the beleaguered cybersecurity space. NVIDIA had been higher. This, of course, is one of the biggest point boosts or drags, given what direction the move is, to the S&P 500, the Nasdaq. Given the fact that it is lower, that's one reason that we're off of the high, something to keep an eye on. And Apple, Scarlett, this is interesting because this one has had a tough time coming out of the pit that it had been in, up 2.4% today. That chart technically looks pretty weak. All of this tech bounce right now, not strong enough to think it's going to have real legs, but the markets overall are higher.
Yeah, I'm looking at Apple, the first gain this week after that two-day sell-off. All right, Abigail, thank you so much with that fantastic summary of all the big equity movers. We spoke with economist Nouriel Roubini, known as Dr. Doom, earlier today, and he believes that investors are getting too pessimistic.
The markets are often wrong about what's going on with the economy and what the Fed is going to be doing. There is some significant, evidence of some slowdown of the economy, but I don't think the data suggests that we're going to have a hard landing anytime soon. If anything, actually, there's some elements of strength in the economy.
Nouriel Roubini there earlier on Bloomberg Television. So let's bring in now Quincy Crosby. She's the LPL Financial Chief Global Strategist with a little bit more. And Quincy, I want to start on this idea that we do have a recovery, a rebound for a second day. But I'm wondering from you, as investors catch their breath from that brutal three-day sell-off, does this rebound look more fragile or more durable to you?
It's looking a little bit more durable. However, we know that when you have a sell-off of the magnitude that we had, the kind of get out now and ask questions later, and with the VIX climbing that much higher, although it's coming down today, it's edging lower, that there are those who lost money, and typically they'll wait for a pocket in the market, usually toward the end of the day if the market has been climbing higher, just like yesterday, in order to get out. So you always pay attention to that because you always have those traders, whether they're retail, whether it's institutional, that they want to get out, and they want to get out at a higher price. So we're going to be cognizant of that. But also, you still have the other questions that got this sell-off going, and that has to do not with the carry trade, but with whether or not the labor market is deteriorating at a faster clip. Remember, that's what started this last week, and whether or not the economy was slowing. So we still have to absorb the data, for example, tomorrow morning on initial unemployment claims and continuing claims. And then we get to next week where there is a host of important data, including the CPI and PPI. But the point is, these kinds of sell-offs don't usually recover that quickly unless the Fed is involved, unless the Fed comes in and does something. So the market is doing it more organically. We've got the easing of that global unwinding of the carry trade. That has certainly helped. Sure. And now we just got to watch whether or not this market wants to see and test if yesterday was a bottom. Normally it isn't. So normally you have to test.
Okay, there's so many different threads to pick up on there, but let me go to what you said about the Fed. The Fed is going to, it's pretty clear we're not getting an emergency rate cut at this point, but there's still a lot of pricing in of a 50 basis point cut come September. And of course, that will be data dependent. So the jobless claims report tomorrow that's coming out, that's the biggest data point for this week. Are a lot of people waiting on it? What is your sense that that's going to be a big catalyst for this week?
It's going to be because what you don't want to see, obviously, is that it inches even higher. You don't want to see that the continuing claims inching higher because it suggests that folks are having difficulty getting jobs. If it is level, it stays where it was last week or it comes down, that would be a positive for a market that has been worried about the economy and that perhaps the economy was sliding too much. You know, we'll also watch the bond market, the treasuries, because the treasury yields were coming down just too fast. They came down telling us there is a scare, an economic scare. And, you know, you have a market that loves to have lower treasury yields, not when it is worried about an economic scare. So we will take that tomorrow. We will see. But overall, the Fed usually doesn't come in unless liquidity dries up. That's the primal fear for the Fed, that liquidity dries up and somehow they've got to get markets going again. That's not happening.
But Quincy, you haven't seen anything in the last few days that suggests that liquidity is drying up, have you?
No, the only thing that we've looked at, because you have to respect what the credit markets are saying, we've seen spreads widen at the lower end, less quality ranking of the credit market. But no, and normally when you get a VIX that high, you would think that we were all talking about credit default swaps, the North American credit default swap index, because that tells you the real fear in the market about what could happen. We didn't hear that. So this is a little bit of an easing, but what we know is sometimes in August, everyone knows this, the volatility, the pockets of volatility can continue. And right now we'll be looking end of today, are we seeing more selling in this market from those who need to capture some gains that they lost yesterday?
Yeah, you're describing forced selling, that kind of disorderly price action that can overwhelm the market. What asset class do you look to, Quincy, to kind of lead the way as the best leading indicator for you? You mentioned bonds. Is it bonds? Is it currencies? Is it credit?
Well, the currency market is beautiful in terms of sniffing out what's going on, whether the dollar moves higher, whether the dollar moves lower. I mean, it's always there before everything else. But what we'll be looking at, we want to see the banks. The banks had been leading before all of this happened. We want to see, for example, as the XLF gaining momentum and staying there. That would be a helpful sign that we're going to free worries about the economy, free worries about whether or not the labor market was disintegrating to the point that the Fed needed to come in. That's what we want to see. And I'm paying very close attention to the financials.
Fantastic place to end it. And of course, XLF right now up 1.2%, adding to yesterday's 1.6% advance. LPL Financial Chief Global Strategist Quincy Crosby. And of course, she mentioned currencies. Coming up, we're looking at the Japanese yen weaker against all 16 major currencies. The Bank of Japan signaling it will hold on interest rates. And that, of course, is helping this relief rally across risk assets. This is Bloomberg.